Hi, it's Jill Schlesinger, host of the Better Off podcast. Today, we're talking about how to incorporate a values-based approach to your investing.
I think one of the things that we lose sight of sometimes, especially when it comes to investing, we just think more money, higher returns, et cetera, is, well, what if the best way to kind of convert that money into what we want is through our portfolios, through how we invest?
Welcome to the Better Off podcast. We're sponsored by Betterment, the largest online financial advisor. Have you been struggling with reconciling your investment portfolio with your value system? Are you trying to figure out how to invest for the world you want? Well, we have a special guest today. We have Dan Egan, who is the Director of Behavioral Finance and Investing at Betterment, our sponsor, who is here to talk about how you can do that. Now, I should note that right after we did this interview, unfortunately, there was a Labor Department caution about these types of investments specifically for retirement plans. These are ESG investments, which take environmental, social, and government factors into account. And right now, the Labor Department, under Director Alexander Acosta, says he's not so sure that these ESG funds should be in 401k plans. So I just put that out there as a caution and a little addendum to the interview. We're going to get into a lot of different ways that you can incorporate your values into your investments with Dan Egan. If you've got questions after we go through the interview, feel free to send us a note. Ask Jill at betteroffpodcast.com. And now, here's our interview with Dan Egan.
You're listening to Better Off with Jill Schlesinger.
Dan Egan, Director of Behavioral Finance and Investing at our sponsor, Betterment. Welcome back to the studio. How are you, man?
Very well. How are you?
I'm great. Just wrote this new article, which is essentially titled "Investing for the World You Want." Why'd you write this article?
So, I'll take a step back. So you've been in the field for years. You know all about financial planning and money and investing. And I think one of the things we get sort of caught up in is the idea of just having more money, and we forget that money is only sort of worth spending on something that makes you happy or more content, right? And that might be goods and services, but it also might be making the world into a place where you want to live. So you look back in sort of American history, we took large tracts of land and made them into national parks. And we said that's actually going to be a better long-term use of that resource for us than it would be if we developed it. I think one of the things that we lose sight of sometimes, especially when it comes to investing, we just think more money, higher returns, et cetera, is, well, what if the best way to kind of convert that money into what we want is through our portfolios, through how we invest? There's generally sort of at a simple level, you can think about, well, I can take money and give to charity.
Right.
That's sort of a direct transfer.
Yep.
Or I could invest in companies that I want to be sustainable and that I want to create the goods and services to help people in the world that might be set up as a corporation. I sort of look at it as we have, we can choose what to do with our money. If it sometimes means investing differently, maybe making a little bit less money on the returns, but that money goes out and helps communities or sort of at-risk populations that we want to help support. That's a really good use of our money.
So, I mean, when I think about social investing, I go back years and I think, well, this was the early stages of this was, hey, I don't want to own a tobacco company. Like, That's just bad, right?
Yep.
And I really don't want to support that. Except a lot of those big tobacco companies were part of big indexes. So it was really difficult to kind of scrub a portfolio of those types of perceived bad companies, quote unquote bad companies. And, there were some competitors that were able to create that. I think that Amy Domini was like the first who did this at Domini Social Index Fund, and there were different ones. But everybody's got a something.
Yep. You're
talking about putting your money to good. What if you want to kind of scrub your portfolio of those companies that are distasteful to you?
Yep. This is a really tough one, I think. This is one of the people in the behavioral finance literature talk about this as like the disgust factor, the yuck factor. I don't want to benefit from selling of guns or, like you said, alcohol, tobacco, or firearms. Are
Well, no,
generally
alcohol I'm fine with.
There you go. Well, and I think that's the thing. There are also people who are on the flip side of that.
Right.
I think there's the sort of question there is, it's one thing to have a gut reaction and say like, yuck, I don't want to be part of that. But if you really want to be thoughtful about what do you want to achieve in the world, maybe how you invest isn't the best way to do it, especially in indices where we're investing in existing publicly listed companies. You're not really going to influence their share price too much by trying to divest from them. And oftentimes somebody who is greedy and doesn't have your same moral point of view is going to come in and buy that up at a cheap price anyway. So I think that's the most interesting thing is like getting over the initial hump of like how I feel about something and saying, what's the most effective way to change the world in the way towards the way I want it to be. Strangely enough, sometimes that's actually owning more of that company.
Right, because then you have a voice.
Exactly.
Then you have you can say, I can agitate. I would rather. So, for example, there was this big controversy, obviously, after Parkland, and people were saying, well, maybe we should get these big mutual fund companies or investment companies who own tons of stock to agitate with these companies and essentially say, stop making these crazy guns that kill, so many people. Like one thing to have a shotgun or a rifle or a handgun, but we don't really need these semi-automatic military guns manufactured. Is that plausible in this day and age?
So I think we haven't seen it done very well at scale yet because it's cheaper for sort of most funds to manufacture something where they say, like, we're just going to divest of this specific thing that we don't want inside of it. Engaging with management is much tougher. It takes a little bit more of a desire to really change it. But think about it this way. This is something that hedge funds have been doing for the longest time. They build up to like a 5, 10, 15% stake, and all of a sudden they demand a seat at the table. They demand that management changes their practices or even ousting the CEO. I've seen activists getting involved in management discussions with as little as 1% of the company's outstanding capital.
Talk about incorporating your values into your investments, but also adhering to a passive investment strategy. How do you reconcile those?
So I've grown to have a slight frustration with the whole passive term. Just
really, why?
I think people overload it with too many different meanings.
Okay, let's talk about the meaning that you think about when you say passive.
Sure. So I think the meaning that I mean is not trying to second guess the market too much and paying too much in order to play that game.
Mm-hmm.
So you can think about maybe I trade a lot of stocks myself and I'm paying commissions when I trade, or maybe I buy a mutual fund that says it's going to beat the market and I pay more in management costs. That sort of second guessing the market or really like having high cost of turnover of trying to beat it, that's definitely something that I would avoid. But some people say, oh, well, that means that you just have to track the index perfectly. And I don't think that's quite right.
Well, I think of it as maybe closer to what you just said, which is I think passive is two things. I think that number one, it's not mucking around with your investment structure once you create it. That's an easy one. But I also think that there is something to be said for minimizing your fees with a fixed basket, whatever that basket is. So it doesn't have to mean that you only buy index funds, but it does have to mean that you're trying to buy things that don't turn over all the time.
Absolutely.
Explain how somebody who hews to a more passive approach can avoid this churn of just buying the companies you like or trying to get rid of the companies you don't like. The company you like today could be a company you hate tomorrow. So what should the approach be?
So I always think that it's really great to set out sort of a process or your set of principles when you first do it. Like I don't like making sort of decisions in the moment because I know that's when I'm most likely to make a bad decision. But, in a cold state of mind, say, okay, how am I going to evaluate companies?
And why should I be? Because how do I know what I'm doing?
Yep. And I think that's where it's worth paying a little bit for an intermediary to just basically outsource that. I don't cut my own hair. I'm happy paying somebody to do it.
Really? I'm shocked that you say that. I'm looking at your hair right now.
So I think there's, you said in terms of passive, I think that saying I want to strategically pick companies that are higher rated on environmental, social, and governance factors. There's going to be a third party who does that systematically. They're going to go in and look at how the board's operating, whether or not the company has.
And what are those companies? Are those accessible? If I have a Betterment account, is that something that's accessible? Is there an algorithm for that?
So one of the things that, again, coming back to View Ourselves is doing is taking customers' desires and trying to figure out the most effective way to achieve them. And easily one of the top things people have been asking for over the past 4 or 5 years was, I want some way of investing in a socially and environmentally responsible manner. So I would guess about 18 months ago, we launched our SRI ESG portfolios.
Can you stop with your alphabet soup?
Sorry.
And so ready? Let's do that again. So tell me, what does SRI mean?
So SRI is socially responsible investing. ESG is environmental social governance. Mm-hmm. And both of these are ways of basically saying we want to assess companies on things other than their profitability, other than their share price. Some even go so far as being B Corps, which are built into their corporate structure, is that they want to follow certain ethical standards. So if you want to invest in a way that says, I want to overweight companies that basically are acting as good actors in the marketplace, even if they aren't the most profitable, it's a way of rewarding them for taking that hit and doing it in a systematic, transparent manner.
Talk a little bit about what you give up potentially when you say a little bit. What does that mean? If I need a way to quantify, because I'm willing to give up a little bit, but a little bit means something different to every single person.
Yep. So there's the weird thing. We sort of say that because your portfolio is going to be a little bit more concentrated, right? So you're not going to have the full diversification. You're going to avoid some really bad actors. And that just puts you into a slightly less diversified portfolio. At the end of the day, we're not really sure what's going to happen. It really could be that companies that follow these ethical standards actually end up outperforming. You could end up doing better. So from a risk management point of view, it looks like, it's a bit less diversified. There's going to be a little bit higher cost because we have to pay people to continually assess the companies. But we don't know what a little is because we're going to only know in hindsight.
And what about on the fixed income side and the bond side? Are you avoiding those companies that are issuing bonds in the same exact way? Same screeners?
So there's not as much out there right now to do that, especially not in the ETF space where there's sort of more transactional volume. We are seeing more and more of it, and I do think that the ability for companies to raise debt is probably going to be a lot more. They'll be more sensitive to that if they need to do it. So I do think that corporate bonds that follow ESG things, I've seen 2 or 3 come out in the past year. It's a very interesting space to look at, but they're also just not big yet. They're not a big part of the market.
Because you could say, I want, I really would like to avoid some of these bad actors, but then you end up owning the bonds of those bad actors anyway.
Very true. Corporate bonds make up a relatively small part of the overall fixed income basket compared to treasuries and other nationals, but you're absolutely right. Can I ask you a question?
Yeah, why not?
So you've been a CFP for years.
I know, so many years.
So many years. You must have had these conversations with clients too. Like I have them with 300,000 clients.
But remember, I have not been in practice for almost 10 years. And in that, when I was in practice, there weren't as many alternatives. And so essentially what I would say to people is this. This is like the biggest punt in the universe. I'd say make as much money as you possibly can and then give your money away. That was really because I do feel like it is awfully hard to. I mean, I was a passive investor. I was the chief investment officer of a firm where we used indexes mostly. And as a result, I couldn't extract the bad actors from the index. And so my feeling was that, you know what? Be charitable in a very micro way. Give your money away, and that's the best thing we can do. Today, I might have a different opinion, although I still tend to be more like that, I have to say, because I feel like it's very hard to accomplish so much. And there are a lot of bad actors in different ways. So environmental groups, you might have thought that, 3 years ago, you might have thought Volkswagen was a really good actor in the universe, and then it becomes a bad actor. So I think it's a bit of a slippery slope. I don't invest that way personally, and because I'm really boring. I'm a straight up passive index investor.
I think there's a lot to be said for that kind of focus where you say, I'm going to assess my companies in terms of how well they do financially, and then I'm going to take my profits and I'm going to put them towards really focused charitable organizations.
When I realized that after tax reform went into effect, I was, I sort of thought everyone said this is going to be terrible for charities. And I was like, no, it's not. Everybody's like much more interested in the value system that they have. And I don't think people give for a tax break. I think people give because they want to give. So it may be that you feel like, hey, this administration is dismantling the EPA and I need to give to environmental causes much more today than I did 3 years ago. That's a valid way to approach it. And if you are a gun lover, then go out and buy Remington and get them out of bankruptcy. I don't care, but that's your choice. I just have a really hard time reconciling a prudent investment approach. It's almost easier to do it as a consumer than it is as an investor.
Completely agree. I know from, working at a company that it's hard enough to sort of figure out what you're doing as a company and do the right thing. And then when you're splitting your time between, we need to make money, but we also need to adhere to these guidelines, it can get very confusing. And I think that if you're focused in serving your clients, talking about Remington years ago, they started really trying to make safer guns, which involved things like biometric locks. And there was a lot of innovation around that period that as consumers, if we had gone out and said what we want are safe guns, they would have been much more responsive to it. It's so easy to say, well, if we want to maximize profits, let's make what the people want.
This is Better Off with Jill Schlesinger.
We'll get back to our interview with Dan Egan in just a minute. So, we're coming into the spring. It finally feels like spring. And we got through tax season. You're feeling good. Before you shut down and go into your whole summertime slump, here's a question. How do you know that you are saving and investing for the life you want? I know that finances can be confusing. And certainly understanding the market not only can be intimidating, but it's really hard. Fortunately, our sponsor, Betterment, is hoping to change that. At Betterment, hidden costs are nowhere to be found. No matter who you are or how much money you invest, you get everything for one low, transparent management fee. And as a fiduciary, Betterment makes recommendations in clients' best interests. They're not incentivized to recommend certain funds. They don't even have their own investment products to sell. Remember, all investing involves risk. Better Off listeners can get up to 1 year managed free. For more information, visit betterment.com/betteroff. That's betterment.com/betteroff. And now back to our interview with Dan Egan. Okay, what other trends are you seeing around the investing world? This idea of aligning your value system, it seems like it's very millennial in many ways, that people want to do business with brands that they are aligned, they align with that value proposition. Is there anything new that you are seeing that incorporates more of an emotional impact with the financial world?
So I think there's a couple of things. One is that on the existing large corporation side, we can see that scandals have a bigger and more immediate effect. So when a company does something bad, it sort of feels like there's so many examples over the past year that it's crazy.
Pick one.
We have Starbucks.
Poor Schultz. He's like this big time liberal, and something rotten happens in his store.
One random employee, United Airlines, dragging clients off the plane.
Killing dogs. What airline was killing dogs? Was it United also? Note to self, don't fly United.
Fly United. So I think that there is, because of the fact that we're more connected, there's more sort of like a social network and herding effect going on that. There can be immediate hitbacks on like, this is something that was really bad and you really need to fix it and show that you're sorry for it. On the other hand, I kind of feel like it's a flash in the pan. Like we said, they come, they go. We kind of remember that maybe we don't want United. But how do you reward United or somebody else for changing things? And in that case, I think that on the opposite side of it, more sort of towards crowdfunding or direct impact investing, things like Kiva, where you're able to say, here's an individual who basically needs to refinance their student loans, and I want to help them do it. Mm-hmm. The ability to connect with people who are basically good bets from a sort of charitable investing point of view has gone up dramatically. And I think that, if it means that you occasionally make a little bit less money, you can chalk it up in your mind to saying, well, the point of that was to do good. And if I achieve that, I'm okay with it.
And a lot of the big banks have arms of their investment banks that are trying to really do these micro lending and socially impactful investments. But these are not something that you and I can necessarily invest in. So how do we bring that to the masses?
I think it's happening. I think it's going to continue to happen. I always like another element of it that is sort of a less appreciated part of this is that technology is playing things. So in, I believe it was Africa, they had M-Pesa, which is basically a way that you can pay bills and transfer money over your phone. And this cheap mobile phones and the ability to transfer money over the phones allowed people to figure out which markets they should be selling their fish in, and allowed like a lot of improvements in the standards of living. The other thing it did is allows us to track and learn from things faster. So technology usually records down that data just as part and parcel of what it does. And if we then can learn what works and what doesn't work even faster, it makes putting money into those sort of charitable exercises all the more attractive.
Interesting. So there's been no bear market since Betterment has been in existence. There are a lot of people who are younger ones who have not lived through a bear market. So what messaging do you want to give to them? Because you're a left brain, right brain guy. That's what behavioral finance is,
absolutely.
right? So what can we do when we have one of those churning, horrible days? And the Dow's down 1,000 points, or the S&P's down 5%, and it's scary. What is a good way for people to acknowledge I'm freaking out, but not do anything with that feeling?
I think the first thing you said is one of the most important, which is far too often financial advisors come out and they say, like, do nothing, stay the course, ignore it, right? And it's like, it's like being a kid and like having an itch. And just saying those things is the hardest thing in the world. It's not helpful. So the first thing is to, I think about it in the context of when you need the money. So far too often, like I was looking at this back. Do you remember in early 2016 when the markets dropped?
Yes, I remember. It was the worst first 3 weeks in the market
right,
ever.
Exactly.
That's something weird like that.
Some stat like that. I remember looking at my retirement account and being like, I was down, I don't know, some significant percent. I think it ended up going down 15 or 20%. But how much I needed to save for retirement had gone up by something like $25 a month.
Oh, that's interesting.
Right? So there's this thing that's kind of like, we get so, and this is really the issue with humans. If there's one thing I could fix, it's that we would stop being so focused on the right here and right now.
Stop being so human, Dan.
Yeah. Yep. Hey, you got to have goals. You got to have something to change here. The part of, I think, the journey is to live through those sorts of things and know that they're going to happen. If you try and sidestep them, you're kind of not doing your job. I think of investing as part of you bear risk and you get return back. If you're not bearing risk, you should be in a savings account.
Dan, as the great Alanis Morissette once said, the only way out is through. You do have to go through these times. And actually, the more that you go through it, the better you get. May is going to mean that this is the second longest recovery on record.
Yep.
Okay? I'm freaked out by it because I know that we are not going to all of a sudden rescind the business cycle, that we will have a recession. So all I want is for it to happen, and I want there to be a bear market. And the longer this goes on, it's like the longer it goes on, the more uptight I get.
Yeah.
Because I know it's going to happen.
Yep.
And I do feel like there is a bit of investor amnesia that goes on. So I worry, now I don't have a company. I don't have to care, right? But I do worry that people become a little fat, dumb, and happy.
Yeah.
And they forget that bad things can happen.
Let me moderate that a little bit.
Why not?
All right. So
I've been moderated before.
There have been only two in the past, I don't know, what is this, 150 years of our financial market, only 2 times where something that bad happened. So there was 1930 and 2008-9.
So I got that one out of the way.
Yep.
But there'll be another 20% decline. That's no big deal.
Absolutely.
And there'll be a recession, and the recession will last for a year. Big deal, right?
Yeah.
I mean, as long as you don't lose your... Please don't hear that the wrong way, everybody. I know that bad things happen during recessions, but it won't be... What you're saying is the Great Recession...
Yes.
Is unlikely to recur.
These things, we remember them. Think about, like, we don't hear the news about all the car crashes that happen every day, but we hear all the news about the plane crashes that happen. When things are rare and horrible and really salient, that's what stands out, and that's what we remember.
I like the idea that it's unlikely that a cataclysmic event will occur. However, I do think only looking at the optimist upside is dangerous, and that we want to remind people that, hey, just because times are good right now doesn't mean you don't have an emergency reserve fund, or it doesn't mean that you shouldn't continue to save because everything's going up, forever. That we still need to do the work, right?
Absolutely. I think of it as we need to make lots of smaller good decisions and not worry about making one really bad decision. So over the past 5 years that Betterment's been around, we have seen, I believe it's 5 corrections, so a fall in the market of 10% or more, and that one fall of 20%, just over 20%.
19.9. It wasn't a bear market.
Wow. You
2011.
On the point.
Mm-hmm.
All right.
Well, it's just I'm telling you that when you go look it up, everyone's going to say this is the second longest bull market on record because that 19.9% drop in this S&P when we got the credit downgrade.
We got so close.
Got so close. Like, just do it.
So I sort of think about it this way. We have all of these fire drills, let's call them, these drops of 10%. And if you freak out every time there's a drop of 10% and then you're out of it for the following year, right? Then you're actually in just as bad a place as if you had done nothing when the market dropped 10%.
Although there are good things that you can do to avoid a disaster. That's why we buy life insurance, right? It is unlikely when I'm 30 years old that I'm going to drop dead and leave my family destitute. So I transfer the risk and I buy life insurance.
Yep.
But what you're saying is as an investor, you don't really have to necessarily contemplate that.
No, I think that, what we miss out on is we get so focused on what's the market doing? Is it dropping? Should I react to this? And we're not thinking about maybe, like a month ago, I should have been talking to my boss about a raise because then I could save some more money. Maybe I should have been figuring out some kind of side hustle. Like the best way to be on track for any big financial goal is to figure out some way to save a little bit more money. It's really hard to make money in the stock market, especially in a risk-free way. Right.
And so the bottom line lesson, I think, is that the save more, spend less still works.
Yep.
And that your investments aren't, or your house, by the way, is not supposed to rescue you from that for lack of saving.
Yep.
It's just like, wow, it's nice if you beat inflation. Okay, so what is the most important thing that you want people to remember from this whole interview?
I think it's to think really clearly about what you're trying to achieve and then pick whichever method is going to be most effective, right? I personally, I give to a number of different charities. And when I do that, I look at it and I say, I really want to, I want to use this money. It's part of my money. I'm spending it in some way. I want it to be really effective. So go out there and do the work on, number one, what are you trying to achieve? And number two, what's the most effective way to achieve that goal?
And remember, we had right around Giving Tuesday, we had the guy from Charity Navigator on, which is one of the reasons that we love that organization is that it helps you kind of use the same methodical approach when you're giving money as you are investing. Absolutely. And really what I would say for everyone listening, you spend so much time worrying about some of the worries around the markets and I think to hear Dan say, look, it's more important that you're saving a little bit more. Figure that out. I'm not saying you should not go on vacation. Go on vacation if you want. But stop freaking out about the investment side. Concentrate on the things you can control. Did you just get a big tax refund?
Yep.
Was that something that you meant to happen? Why? Is there a more effective way to deploy those assets? Think about it that way.
Yep.
Dan Egan, who is the Director of Behavioral Finance and Investing at our sponsor, Betterment. Thank you for joining us here.
Thank you so much for having me. This was fun.
You're listening to Better Off with Jill Schlesinger.
Okay, it's time for the listener question of the week. Remember, here at Better Off, we've got 2 chances every week to get on the air. After our Thursday interview show, we have the listener question of the week, and then we drop the Better Off bonus call of the week on Tuesdays. Easy way to get in touch with us is by email. Ask Jill at betteroffpodcast.com. Ask Jill at betteroffpodcast.com. Right now, we are going to talk to Lisa from the nation's capital. Hello, Lisa. Welcome to the program. What can I do for you?
Hi, Jill. I would like some help with my retirement planning.
Okay.
So I'm self-employed. I'm a property manager, and I manage about 5 units. I'm married, and thus far, my husband has done the bulk of our retirement savings through his work. He has a 401k through his work that we've been maxing out for a number of years. And then I have a smaller IRA, and he has a small IRA that he rolled over from a prior job.
Okay.
And we are getting to that point where our income is going to pass the threshold where we can no longer contribute to my Roth IRA. So I'm wondering what options I have once that happens.
Okay. So how much do you earn as a self-employed property manager?
Me by myself,
Yep.
I make $40.
Okay. And he makes how much?
Let's see. Well, combined, we pull in about $240, so he's right around $200.
Okay, great. At his work, is his 401k, it's a traditional, not a Roth, right?
Right.
And you've been contributing to a Roth IRA yourself, right?
Yes.
How's your cash flow on the 240 combined income? How are you guys doing?
We're doing pretty well. So we put between 20 and 24% of our monthly income pays our mortgage. We own an apartment in D.C.
Mm-hmm.
And then we put aside between 25 to 30% of our income between long and short-term savings.
That's
and that
great.
Includes our retirement savings.
That's awesome. So how much money do you have in the bank right now?
What, just in like savings accounts?
Yeah, like safe, boring stuff.
Safe, boring stuff, about $20,000.
Okay. You got kids?
I do.
How many?
I have 2.
How old are they?
They are 11 and 5.
Do you do any savings for education for them?
They each have 529 accounts that we've been contributing in since they were born.
Wow. How much money is in each account?
So the 11-year-old has about 90,000 and the 5-year-old 60,000.
Oh my God, you might as well stop now. Everything's good, right? I'm sure they're going to be
So.
They're violists. I know that they'll get a scholarship anyway. How much money have you guys socked away for your retirement thus far? Between the 401k, your IRA, his rollover, what do you have out there?
In total, we have about 250.
Mm-hmm.
We have a strange situation where my husband had been maxing out his 401k for about 5 years when his employer caught that there was a local regulation that limits his ability to contribute to his 401k at the max.
Oh, so, highly compensated.
Yes.
Mm-hmm.
So right now they're treating that as if we had given them a loan to the corporate 401k program, so we get additional payments. So we're grandfathered in because we weren't caught right away. But this year, those will end. And so we'll only be able to put 7.5% with the company match into his 401k.
Okay. But wait a second. Maybe we should just put in a retirement account for you. Have you explored? I mean, I know you don't have huge income, but we could put away probably 10 grand out of the 40 grand in a SEP IRA, or maybe in a for a 401k for yourself. You can actually have basically a one-person 401k because it's only you. You only have your own income, right?
Right.
Okay, no employees.
Right.
I think you may want to explore that, number one, because one of the things that being a small business owner allows you to do is to create your own retirement account. And maybe because he's going to be limited in how much he can put away, we've got to try to put more away through you. And through you, we can do it pre-tax. We still can do it pre-tax for you. That would be something I would absolutely explore. When you invest in all this stuff, are you just managing this yourself? Do you manage his rollover account? Do you have someone who does it for you? Who are you working with, or is it just you guys on your own?
We're doing it ourselves.
Okay. So here's what I want you to do. Do you work with a CPA, by the way?
My husband's actually a CPA. So.
Awesome. Okay. So you and your husband, just for fun, what you're going to do is you're going to start exploring putting a uni 401k or a SEP IRA in place for you. And you should do it for this tax year. And that way you can start to put more of your own income, sock that away pre-tax, and it would essentially make up for what he's probably losing in his. Okay?
Okay.
All right. So that's one part of it. It sounds, though, like you may have more than that to put away. I'm not sure because I'm not sure. How much more do you plan to put away in these 529 plans? I don't want to necessarily overfund them, but I mean, how are you guys planning to proceed at this point?
Well, right now we have like regular monthly payments that we make into the 529s account. They're automatically deducted. And we've been doing that for many years.
Mm-hmm. It sounds to me like you're putting money into retirement, money in the 529. And do you have non-retirement investments?
We have small, like $3,000, so very small.
Okay. So I think at some point, and maybe you guys can just run, because he's a CPA, I know that he can do these figures, facts and figures. Maybe you can do it too. You may want to just run a quick calculation as to, if I had 100 grand at my, right now in my 11-year-old's account, let's say by the end of 2018, That 100 grand would grow at what rate by the time the kid is 17, right? So we have 6 more years. Would that be enough? Would that not be enough? Are you guys planning on public or private university? What's your guess?
I feel like it's a little early to say right now. We'll see what our options are and what he's interested in.
I mean, again, I don't want you to overfund these things, but I mean, if you get the sense that, in a couple of years, maybe you stop doing that, the next level for you in terms of what you would do savings-wise is you put your money away in your retirement account. It's just set up a non-retirement account or add to that non-retirement account. And I presume that would happen sometime after you're kind of done with your 529 funding. But you're doing such an amazing job. And I'm very happy that you have this, sort of this pretty, I would say, diligent and smart way that you're looking at your financial life, and you're saving a lot of money. So I think that that's fantastic. Is there anything else that is going on in your financial life that you need help with?
No, that's my main problem. So I need to look into a SEP IRA.
A SEP IRA or something called a uni 401k. So, and there are off-the-shelf products. I mean, the SEP is an easier thing to set up. Where's the rollover money right now? Where is that held?
That's with Schwab.
I mean, you can just go into, you can go to Schwab and they probably will have some information about SEP IRAs. All these things are off the shelf. You can do it very easily. So check those 2 different ideas out. Keep doing what you're doing, and be clear that, I mean, I was just going to say, let me say one other thing about that 529. Your kids go to private school or public school right now in terms of, I was going to say undergraduate, secondary school. I guess your kid's going to be.
They go to private schools. My family has a trust fund that pays for their private schools.
Oh, I love trust funds. I want a trust fund. Can I get in that action? All right. So that's going to pay for private schools. Is that, but not for college?
I don't know.
Wait a minute. We got to find out about that.
So, right.
Can you?
I wasn't aware of that when I started saving for them, and I haven't made adjustments to my saving strategy since I've found out about this.
I think that you should find out. You don't want to be pushy?
Right.
But how'd you find out about it in the first place?
I had my mother. I had to sign paperwork.
Okay, cat's out of the bag. You got it.
Right.
Why don't you just say to your mom, we're saving a bunch of money for college. Is this something? Should I stop doing that? Just go through the front door. Why not?
Okay.
You think that that's weird? I think that that's like a normal question. I think she'd be like so proud of you for being responsible and saving that money.
Okay.
Or maybe you say, I was talking to this financial chick in a podcast, and she asked me about this, and I didn't know. Should I keep doing this, Mom? Otherwise, we'll save for other stuff. I think that's a reasonable question to ask. I say go for it. All right, good luck.
Thank you so much.
All right, take care. Thanks again to Dan Egan and to our caller, Lisa. Don't forget, we drop new episodes of Better Off every Tuesday and Thursday. You can get them wherever you get your podcasts or hop onto our website, JillOnMoney.com. If you'd like to get on the program, just send us an email. Ask Jill at BetterOffPodcast.com. Our music is composed by Joel Goodman. Mark Talercio is the best ever extraordinary executive producer. We are distributed by Cadence 13, and we're sponsored by Betterment. See you next week.